Hello and welcome. In the world of finance, there are a few things as important or sometimes as confusing as the interest rate. It's everywhere. It affects your savings account, your loans, and it's all over the economic news. So today, our goal is to really demystify this core concept, taking it one piece at a time.
So let's start with the big question on everyone's mind. Why aren't these rates just fixed? Why do they seem to go up and down all the time, sometimes by a lot? Getting a handle on why they move is absolutely key, because these shifts have a huge impact not just on our own wallets, but on the health of the entire economy.
So here's how we're going to break it all down today. First, we'll cover the core concepts, the absolute basics. Then we'll get into the nuts and bolts of how interest is actually calculated. After that, we'll zoom out to see the bigger role interest rates play in the economy. We'll look at what determines them using a classic economic model. And finally, we'll explore the big factors that make them change.
All right, let's dive right into our first section, the core concepts. Before we can understand how interest rates work, we've got to get the fundamental building blocks of any credit deal down first.
At its absolute heart, an interest rate is just the price of credit. It's really like a two-sided coin. If you're the saver or the lender, interest is your reward for not spending your money right away and letting someone else use it. But if you're the borrower, it's the cost you pay for the privilege of using that money right now.
Okay, the second key term you have to know is the principal. This is just the starting amount of money we're talking about, the amount you borrow or the amount you lend. Now, from an accounting perspective, here's the cool part. For the lender, that principal is an asset on their books. But for the borrower, that exact same number is a liability.
Okay, so now that we have those two key terms down, we can move on to the mechanics of how interest is actually calculated. There are two main ways to do it, and believe me, the difference between them is absolutely massive.
First up, we've got simple interest. And just like the name says, it's pretty straightforward. The interest is calculated only on the original principal amount, every single year. So if you save $100 at a 10% annual rate, after 1 year, you get $10 in interest. After year 2, you've earned another $10 for $20 total. It's really that simple, nice and linear.
But the real powerhouse, and honestly the one you'll see almost everywhere, is compound interest. I've heard Albert Einstein call it the eighth wonder of the world. And why is that? Because with compounding, you're earning interest not just on your original money, but also on the interest you've already earned. Your money literally starts making its own money. The formula might look a little intimidating, but the concept is what matters. Your wealth starts to grow exponentially, not just in a straight line. This is the engine that drives all long-term investing.
Now here's a really critical distinction that a lot of people miss. The rate you see advertised by a bank, let's say it's 10%, that's the nominal interest rate. But that number can be really misleading because it ignores a powerful force that eats away at your money, inflation. What you really care about is the real interest rate. That's what you're actually gaining in purchasing power after inflation has taken its bite.
So let's pause for a second and think about that. Your bank is giving you a 2% return. But the cost of everything you buy, gas, groceries, you name it, goes up by 3%. Are you really getting richer? Well, the answer is no, of course not. Your real interest rate is actually negative 1%. Your money can buy less than it could a year ago. The bottom line is this: always think in real terms.
Okay, so we've covered the nuts and bolts. Now let's zoom out and look at the big picture, from personal finance to the whole economy. Interest rates aren't just about our savings or loans. They're a critical lever in the entire economic machine. You can think of them as doing three main jobs in the economy. First, they act as a signal, helping direct the available money to the investment projects that are most likely to succeed and offer the best returns. Second, they're like the market's balancing act, making sure the amount people want to save lines up with the amount businesses want to borrow. And third, they are the #1 tool that central banks, like Bank Nagara, use to manage the economy, either to speed it up or to cool it down.
So if interest rates are so important, what actually decides what the rate should be? Well, to answer that, economists use a really foundational model called the loanable funds framework. It's a great way to visualize all the market forces that are at play.
I want you to think of this just like any other market. On one side, you have the supply of loanable funds. That's basically all of us, households saving our money. On the other side, you have the demand for those funds, which mostly comes from businesses that want to borrow money to grow and invest. And the interest rate? Well, that's just the price that makes both sides happy. It's the equilibrium point where supply meets demand.
But of course, in the real world, that equilibrium point isn't set in stone. It's always moving, getting pushed and pulled by these massive macroeconomic forces. And that brings us to our final and maybe most important section: why these rates never seem to sit still.
There are 4 big economic factors you've got to watch. First, strong economic growth. When the economy is booming, businesses want to borrow more to expand, and that pushes rates up. Second, inflation. Lenders are smart. They know their money will be worth less in the future, so they demand a higher nominal rate to protect their actual return. We call that the Fisher effect. Third is the money supply, which is controlled by the central bank. And finally, government budget deficits, which can cause something we call the crowding out effect.
Let's just pause on that last point for a second, because it's a big deal. If the government suddenly starts borrowing a ton of money to pay for its spending, what do you think happens to the amount of money left over for private companies, or for you and me? Well, the government basically crowds them out. It's competing for the same limited pool of savings, and that pushes interest rates higher for everyone else. It can literally make your car loan or a new startup's funding more expensive.
Let's make this real. We'll walk through a quick example of compounding to see how it works in practice. Let's say a business borrows $1,000 for 3 years at a 10% rate. We plug that into our formula, and you see that at the end of the 3 years, the total amount they owe isn't just $1,300, it's $1,331. That extra $31, that's the magic of compounding. It's interest being paid on the interest. It shows you just how fast the cost of borrowing, or the reward for saving, can pick up speed over time.
All right, let's wrap this up and recap the most important points. First, remember that interest rates are simply the price of credit. Second, that price is set in the market by the supply of savings meeting the demand for investment, which we can visualize with the loanable funds framework. Third, that rate is always moving, reacting to changes in economic growth, inflation, money supply, and government spending. So if you want to predict where interest rates are heading, you've really got to predict where these big economic factors are going first.
And I'll leave you with this final thought to take with you. The next time you see a news headline that a central bank is changing its main policy rate, like Bank Negara's overnight policy rate or the OPR, which affects all the other rates in the economy, you'll now know what to look for. You can ask yourself, which of the forces we just talked about, growth, inflation, government actions, are they reacting to? And that is how you start to apply financial theory to what's happening in the real world. Thank you.